Have you ever noticed how some financial values slowly increase over time, even without new money being added? In finance and accounting, that gradual increase is often called accretion. Accretion is the gradual increase in the value of an asset, liability, or financial instrument over time. In simple terms, it means something is slowly growing in value as time passes. Now, accretion can appear in different areas of finance and accounting, but the core idea stays the same: increase over time. One of the most common examples is with bonds. Imagine an investor buys a bond for less than its face value. For example, they buy a £1,000 bond for £900. Even though they only paid £900, the bond will eventually mature at its full £1,000 value. That £100 increase doesn't happen instantly, it gradually builds over time. That gradual increase is called accretion. So, as the bond gets closer to maturity, its value slowly accretes toward the full amount. Now, accretion also appears in accounting. For example, companies may record accretion expenses related to long-term obligations, such as environmental cleanup costs or asset retirement obligations. As time passes and the payment date gets closer, the recorded liability increases gradually. Again, that increase is accretion. Let's make this really simple. Think of accretion like ice slowly forming layer by layer. The growth is gradual, steady, and happens over time rather than all at once. Now, why is accretion important? Because it helps financial statements reflect economic reality more accurately. Instead of suddenly jumping from one value to another, accretion spreads changes over time so investors and businesses can better understand the true financial position. It also matters for investment analysis because investors often need to calculate how discounted investments grow toward maturity. A common misunderstanding is thinking accretion is the same as appreciation. They're related but not identical. Appreciation usually refers to market value rising because demand increases, like property prices going up. Accretion is more structured and gradual, often based on time, accounting adjustments, or fixed financial agreements. Another misconception is that accretion always involves profit. Not necessarily. In accounting, accretion can also increase liabilities and future obligations. So, what's the key takeaway? Accretion is the gradual increase in value over time, commonly seen in discounted bonds and long-term accounting obligations. It helps spread financial changes steadily, rather than recognizing them all at once. And once you understand accretion, you start to see how finance often measures growth not in sudden jumps, but in slow calculated increases over time.